Hello friends, you are welcome to another new video. In this video, as you have already seen, we are looking at order flow with EURUSD as a case study. In my previous video, I did explain in a bit details what we mean by order flows, where I mentioned that we have external order flow for the higher time frame structure and the internal order flow for the lower time frame structure. So in this particular video, we shall be looking at trading opportunity in the internal order flow, lower time frame structure for EURUSD. We are reminded that whatever concepts we learn, we should back test all concepts. And in this video also, we shall be hinting you about our liquidity inducement. And this is how I really like to see my liquidity inducement. For example, we are in an uptrend. We have a high, a low, then we have a bullish break. After the bullish break, we identify the demand zone that led to the bullish break of structure, and then we see price creating a higher low, but this higher low is not able to break the structure. So in the first place, it does not even qualify for a higher low, just that it's a higher low compared to this, but is an insignificant higher low because it was not able to break the structure high. Okay, in that case, it is most likely going to be used as a liquidity inducement, and that is why we saw price came back, cleared liquidity before resuming the move up that led to this break of structure. That being said, we must also be aware of the fact that sometimes even this higher low can end up breaking structure, and yet price could still come and clear the liquidity that is left below. It's very, very possible. So quickly, we move very fast to what we have today, looking at the opportunities on EURUSD. So quickly we have this. Firstly, what we can notice is that we are in an uptrend and price will continue to trend until a target is met, like we did say in some of our videos initially. Now we can notice that we have a stop point here as a result of this downward move, and price ended up breaking this high that led to this stop point. When we have these conditions, a stop point and a break of structure, the next thing we do is to mark our demand zone. You can notice how I mark my demand zone here, taking the body to the wick. It is left for you, whatever you prefer. Most people will take the wick to the wick. Most people will also take the body to the wick. And the way I like to mark my zone is from the body to the wick, especially if the wick, the upper wick in this case, is kind of too long for me. Okay, so we mark the zone, and after marking the zone, we expect price to come to the zone and either react from the zone or reverse from the zone. So before then, we saw this move downwards, creating this higher low, and this higher low actually ended up breaking this structure. But then you can see that price still came, grabbed the liquidity below this low before the actual move up that led to the break of the structure. So if you have traded from here, you would have gotten a good trade, targeting this high. would have gotten a nice trade nonetheless. And once again, you continue to see opportunities upon opportunities in the market. We have this move, especially this move from this high, from this point to this point. This move led to the break of the structure, the stop hunt, and eventually we have this break of structure. And you can see this candle, this very bullish candle with very large body. You can begin to suspect that smart money is involved. Okay, when you see this. So after the break of structure, we have a stop hunt, break of structure, you mark your demand zone and expect price to come down to react or reverse from that zone. You can see what happened. We have this higher low created, just the same scenario here, which eventually led to the break of the structure. But then price still came, grabbed the liquidity in form of stop hunt, and then break the structure. Okay, when we have this break of structure, we can once again identify this demand zone that led to the break of structure. And in this case, we have this low being created, this higher low. Now this higher low was a weak one because this low was not able to break structure. So it is clear that this low will be used as, or will most likely be used as liquidity inducement, as nothing is 100% certain in trading. So we can always expect that this low will be taken off, and exactly what price did, came down, tapped it, and what do we have? We go to our target. So for instance, if you have traded from this, you would have gotten about 4.8 arrow. So if you have taken this trade, and taken this trade, you would have gotten at least 10 arrow. So that's how trading actually is. You don't get this opportunity all the time, or they are there, you don't get to find them all the time. You need to be very careful when you are trading. And again, you have to apply psychology. Psychology may not have allowed you to take these trades the way they appear here. I hope that is clear. So once again, we are reminded, back test all concepts that you listen to. Okay. The next slide is just showing us the need for us to the importance of time and price, and where we are getting our very important reactions from. Okay. Now, on my chart, I have these indicators, basically time and price indicators. I have this CM Forex. Okay, let me zoom it. I have this CM Forex session highlight. I have ICT key zones, B2, Asian session high, low, mid lines. These are the indicators that I have on my chart. Now this CM Forex session highlight just is responsible for telling us the sessions. For example, we have this London session, from this London open to this London close. This is a London session. Okay, and from this point, this is New York open to New York close. This is a New York session. Okay, the time is also indicated based on New York time. Okay, ICT key zones, you can see this portion from this point to this point, this light green portion, according to my own setting, is actually the London kill zone. I think from 2 a.m. New York time to 5 a.m. New York time. It's a London kill zone. Why this point, this light pink area, is a New York kill zone from 7 a.m. New York time to 9 a.m. or to 10 a.m. New York time or thereabouts is a New York kill zone. Now, what's the idea of the kill zone? We have to watch out for the kill zone because that is where most likely, credit to ICT, we might be getting those stop ons and those big reactions. So you can look very closely. This first stop on we had was in what? London kill zone. When you see something like this, a stop on and a break of structure, most likely you might get a good trade. And coming to the New York kill zone again, we have another stop on and a break of structure. We can trade from here and capture a very good buy trade upwards. So this is just to tell you the concept of the importance of time and price according to ICT. So the time you place your trade is very, very key. And when you see those liquidity graph during those New York or London session overlap and all those things, it gives you more confidence that the trade might go well with you. So with that, I once again want to thank you for your time, and I wish you the best in your trading.